My dog is already in his little position on the couch, so we're just not going to touch the blanket situation today because I cannot move him off of his blankets, obviously. But today we're going to be talking about what to do with your paycheck. And I'm actually going to make 2 videos on this exact same topic. So today, this video is going to be more for beginners. So if you are in a place where you feel like your spending's out of control, you don't know where your money's going, you feel kind of lost, maybe you don't even have different accounts set up, maybe you have one checking account and you kind of just operate out of there, this is the video for you. If you're someone who's a little bit more advanced, maybe you already have automatic savings, investments, maybe you already have multiple types of accounts set up, and you're kind of looking to make sure you're on the right path or maybe streamline with a little bit more of advanced knowledge, then a future video I'm making after this will be the one for you. So let's get into what to do with your paycheck as a beginner and someone who really wants to get control of their finances from a place of feeling out of control. On this channel, I love to talk about personal finance, tips on increasing your income, and side hustles. So if those things interest you, you should definitely subscribe. Let's just get straight into it. So the first thing you want to do, and this is the major thing, is automate everything. And I know you've probably heard this advice many other times, but I'm actually going to go really deep into what automate everything actually means, because everyone says that, but there are a lot of steps underneath that you can get a lot more specific, and that's what I want to get into in this video. So the first thing that involves in setting up everything to be automated is you want to first start out with your checking account. So that's the first base level we're going to start at. What you want to do if you're a beginner is get 2 checking accounts. Right now, maybe you probably only have one checking account that you're kind of functioning out of and probably doing all of your transactions from. I would open another checking account at your same financial institution. I'll get into what you're going to use these for later, but let's just stick to the kinds of accounts you want to set up first. You're going to have your 2 checking accounts. You're going to have one savings account that you want to open up. This is going to be a high yield savings account or an HYSA. And the only thing about this is you literally just earn more interest on your money. It might sound fancy and it's a lot of acronyms to always keep track of, but really this is just a savings account that's at a separate institution that's not your regular checking account banking institution, where you're going to keep all of your cash for savings. And you want to set this account up at a separate place so it's not easily accessible with your checking accounts, and also so you can get a higher rate so you're not just sitting there having your savings literally accumulate virtually no interest. The next account you want to open up is a retirement account. So you may or may not have one of these depending on your employer situation, but if you have a job, you likely have access to a 401k. So that is the first type of retirement account you can open up. In addition to a 401k, you can also open up a Roth IRA, and I would actually recommend having both of these accounts. If you're unable to have a 401k through a traditional job, you can also just have a Roth IRA. And an IRA just means an individual retirement account. So this is an account that's not sponsored or gone through an employer, if that makes sense. So it's just something that you manage on your own. So it doesn't have to do anything with your employer. And the last type of account you want to open is a investment account. So this is just your regular taxable brokerage account. And this account can be used for investing, but it is not tied to any kind of limits or rules like retirement accounts are. So those are all of the accounts that you want to open up. It might sound already kind of like overwhelming if you're a beginner, but it's actually quite simple. So let's break it down step by step. So let's go back to the checking accounts. So you likely already have a checking account now. All you want to do is open another checking account at your same bank. And the reason you want 2 of these is because you want to have one that is for your essential expenses, like all of your bills, and one account that is for all of your other spending that varies and you can kind of adjust every month. That's the reason why you want to have these 2 different accounts. So in your bills account, everything is going to be paid out of there, like your mortgage or your rent, your utilities, insurance, all of your fixed bills that you need to pay every single month, or else bad things will happen if you don't pay these. So this is also kind of like your bare bones expenses in a way. It's all of the bills that just have to be paid every single month. That's going to be for your bills checking account. And in your second checking account, this is going to be for all of your spending. So you can put groceries, eating out, going out with friends, all of your kind of transactions that are fun to do and you don't necessarily need. So with your bills account, you want to calculate what your fixed bills are every month, calculate your rent payment, your utilities, your insurance, Those are probably the main ones. I'm probably forgetting a few now. But anything that you review in your own financial situation that is a fixed bill every month. You want to add all of those up to calculate your fixed bills. You want to add 10% is what I would recommend for a buffer. Also, because sometimes utilities tend to shift slightly. Once you have that number, let's say it's $3,000. You want to transfer half of that amount per paycheck. So this is for bi-weekly paychecks. You can adjust this to your own situation. If you get paid every week, it would be 4 times. And then bi-weekly paychecks are the most common. So I'm going to be speaking kind of to that situation right now. You want to transfer half this amount per paycheck. So if you get paid, you want to transfer $1,500 to your bills account. And then the second time you get paid that month, you transfer $1,500 again to the bills account. If that makes sense, it equals $3,000, which you determined was your fixed bill cost. This will basically ensure that you always have enough money in your bills account that can pay all of your fixed expenses, and you don't have to worry about it getting confused with money that you spend on things that vary or things that you want. Now to your spending account. This is the account that you can swipe and not feel guilty or worry about what you're spending on. Once that spending account hits 0, then there's no more spending. There's no transferring from other places. There's no thinking about if it's going to impact your bill payment because your bills are already paid. So once that account hits 0, then you're done for the month. And you can plan for that by looking how much you have in this account and saying, okay, I can spend a little bit more this week. Maybe I have to pull back a little bit because my spending account's getting low. And you just adjust your spending based on how much that one account has as a balance. So let's go back to the second account, which is your high yield savings account. So this is what you want to open. There are several different institutions that have one. I personally have one with American Express, but there's a bunch of other banks like SoFi and Ally are really nice ones I've heard. I think it's SoFi that actually lets you split up into different buckets, which if I would have known that, I opened my high yield savings account without honestly doing that much research, and I kind of wish I would have. Because I probably would have opened one with SoFi just because I think it's cool how you can have different buckets. So you can have one savings account, but you can have different buckets with different names. So if you want to say one is for vacation, or one is for maybe your pets, and one is for gifts for the holidays, you can kind of put those labels and then you can deposit the money and split it up that way. So if you want to be a little bit more detailed, but honestly, especially if you're a beginner, it's fine to just have a high yield savings account where you're just automatically putting money into that and not thinking about how you're going to divide up, let's say $200 into a bunch of other smaller buckets that make up that $200. If you're a beginner, I would just focus on setting up that auto transfer to your high yield savings account. So you want to open up this account and have an automatic transfer set up on your payday so that as soon as the paycheck hits your account, that same day you're also getting a deduction taken out and going to your savings account. And once you set that up once, you don't have to think about it again. Set a fixed number, and let's say it's $150 that you want to contribute to that savings account every paycheck. Once the paycheck hits your account, it will just automatically send that much also to your savings account, and then you don't have to think about if you're actively saving or not. Now back to our retirement accounts. So these are the 401k and the Roth IRA that I mentioned earlier. So a 401k, that deduction comes straight out of your paycheck. So if you do have a 401k or your employer does have an option for you to open one, which pretty much all employers do, then this is an easy deduction that can be done through payroll, and you can easily contact your HR department and have them deduct a certain amount, usually a percentage from your paycheck. And I would recommend doing a percentage for all of these because it will gradually scale with your income, especially because your income tends to go up, especially if you're younger. So using percentages is actually a much better idea than just setting like an arbitrary flat rate number, because that might not actually get you where you want to go. So I always suggest percentages, and it's very easy to do this. Just ask your HR department. It'll be super easy to set up. And once you figure out how much percent you can afford to do, that deduction will come straight out of your paycheck. So that's the easiest way to have automatic transfer set up, because that's the only one that's actually pre-tax. After that, with a Roth IRA, this is a contribution that will be made with post-tax dollars. And all that means is that it's money that you take after you get your paycheck, and your taxes are already deducted from your paycheck if you do have a regular W-2 job. So you transfer this money, have it automatically set up to transfer a certain percentage to your Roth IRA. You have a little bit more control over this because it is an individual retirement account as opposed to a 401k. Just to do a really fast, quick overview of the difference, a 401k is contributed to with pre-tax dollars. So these are deducted from your paycheck before it hits your account. While a Roth IRA, the contributions are made with post-tax dollars. 401k, the amount grows with pre-tax dollars and it reduces your taxable income right now. Where a Roth IRA, the contributions are already taxed, and then once they grow tax-free. So when you withdraw the amount, you're not taxed on it. So that's a really just quick overview. I don't want to get too much into that because this is about what to do with your paycheck, but that's just a quick overview of the difference between those two accounts and why it also makes sense to have both accounts in case you were wondering, do I need both? If you can have both, I would say have both because they are different. Also, the limits are drastically different for these two accounts. I can put the limits on the screen. I don't remember exactly how much they are for this year and going into next year, but the limit for your 401k contribution is drastically higher. It's probably about three times higher than what the limit for a Roth IRA contributions are annually. So now that you have your checking account, your savings account, and your retirement accounts set up, the last type of account is just a regular investing taxable brokerage account. I would recommend having one of these because it gives you a lot more flexibility. It gives you an investment account that is not tied to any sort of retirement rules. So these accounts don't have any rules like age limits or contribution limits. So these are a lot more flexible, and you want to also have this in your mix of accounts because it does have different benefits and offers you different benefits than having just the other types of investment accounts do. For example, if you had a really great gain and you want to withdraw your earnings and sell your shares, you can do that without paying a penalty because it's just a taxable brokerage account and it has nothing to do with retirement, but you still will owe capital gains tax on that. If you realize those profits, you will have to pay taxes on them. Since the account is not intended for a retirement use, there's no penalty for doing so. So now that we've talked about the types of accounts that you need and how to set up automatic transfers, let's get into how do you know how much you can actually transfer and figure out this number. So you always want to operate with percentages, and this is because percentages will scale up and down with income, like I mentioned earlier. So if your income goes up or down, the percentage that you are allocating to each of these different buckets will fluctuate with that. And that is what you want to do so that you don't accidentally maybe increase your income. And then before you know it, you realize that the numbers you set for your automatic savings and investments are now way too low because your income has gone up a lot. So this is how you just avoid that altogether. In an ideal world, you would be able to save 20 to 30% of your income. And by save, I mean that between your savings account, your 401k, your Roth IRA, and your taxable brokerage account, altogether, the amount of money in those four accounts would be 20 to 30% of your income in an ideal situation. I know that's not necessarily feasible, especially now for everyone. What you want to do is avoid getting so defeated by if you can't hit that number that you don't start. The worst thing you can do is say, I have $50 left over at the end of the month. What's the point in having a savings account? Two different types of retirement accounts and a taxable brokerage account when I have $50. What am I going to do? Put $10 into each account? Because this is what I used to do. And it's like, what's the point of putting $10 a month into all these accounts? I don't have enough. Don't want to tell yourself that. You have enough. If you can spare even literally $5, if you put $5 a month into a brokerage account or in a savings account, you're doing better than zero because anything is better than nothing. The amount that you can afford to put towards all of your different types of savings and investments will obviously come from how much your fixed expenses are compared to your income. So for example, let's say that my take-home pay is $3,000 a month. If I have two paychecks that are $1,500 each. Let's say that my fixed expenses add up to about $2,000 a month. So that's all the money that I need to put into my bills checking account, which is checking account 1. So let's say that the $2,000 a month is the total of my rent, my utilities, all of my insurance, and anything else that is a fixed bill for the month, maybe credit card bill payments if you have debt. Let's say all of that adds up to $2,000 a month. So that is all in your bills account. That's already taken care of. So then that leaves $1,000 a month that's going to be in your spending checking account. So With this $1,000, you would ideally have $300 of this go towards all of those accounts. Again, that's not each account, that's in total, because that is 30% of the $1,000 that you have left over. So if you can do $300 allocated to each of these accounts in a proportion that makes sense for you. For example, let's say you have zero emergency fund and you want to start building that up first. Maybe you do $200 a month in your emergency fund, and then you split the $100. Maybe you have one of the retirement accounts and not both. Maybe you don't want to even mess with the taxable brokerage account until you have both types of retirement accounts, the 401k and the Roth IRA. Maybe you split $50 each to each of those retirement accounts and put the taxable brokerage off for a while. This is just an example. It's not that you have to follow that exact methodology. Just using a simple numbers example, that $1,000, you would subtract out 30%, and you would save and invest that amount, and then you would have $700 a month to have in your spending account. So that's all of the amount you can spend on whatever you want, and you don't have to care or think about what it's for. That's the biggest thing, is it takes out this headache, it takes out guilt, it takes out feeling like you're doing something bad because you're overspending on clothes or whatever it is that you want, and you're like knowing in the back of your mind that you're not saving money, and that's where you start to kind of spiral and get really upset at yourself for maybe doing something wrong. This gets rid of all of those types of feelings, which is why it's so powerful. So now you have $700 a month to spend on whatever you want. You can swipe your debit card for that checking account and not have to think about what it is. If it's something you like and something you want to spend the money on, you can spend it. And you just periodically check the amount in your spending checking account. And once it's gone, it's gone. Then you avoid moving money around because maybe you're not even sure how much your bills are or how much you want to spend every month. You're just kind of like moving things around to like spend more than you want. This makes sure that you're not doing any of that. And if you happen to have leftover money in your spending checking account at the end of the month, put that right towards savings, because then it's kind of like giving yourself a bonus. Like, oh, maybe I had $700 a month in my spending checking account. Let's say I have $50 left in that account at the end of the month that I didn't spend. Maybe I put that $50 into my Roth IRA, or maybe I put that $50 into my savings account. Just that little bit of extra, maybe you didn't need that month, and you can just put it away for the future. Another tip I will give is when you get a raise, use half of it for savings and half of it to fund lifestyle inflation or whatever, making your life better in whatever way. I think avoiding lifestyle inflation is very important, and it's very hard to do, but I also don't think you need to avoid it altogether, because that's kind of unrealistic. Also, if you're increasing your income, if you're younger and at kind of more the beginning of your career and you're projected to make more, you should also plan to live a better life. There's nothing wrong with that. But when you do this 50-50 method, it just takes care of the savings aspect of it. So again, you don't feel bad about spending extra maybe when you get a raise. So if you get a raise, let's say you get a $4,000 annual raise at your job. This is, of course, gross and not net, but just for the sake of example, $2,000 of that can go towards inflating your lifestyle and giving you some sort of better lifestyle in whatever way that means for you. It might mean spending a little bit more on clothes. It might mean like getting your hair done more often or going to get a facial, whatever the lifestyle inflation definition means for you. $2,000 can go towards that per year, and then $2,000 will go towards just bumping up your savings percentage. Let's say you could only afford to put 5% in your savings account. Maybe you bump that up to 6% thanks to the raise. So that's just kind of a little extra tip for when you get a raise. But if you're working in percentages already, then this will take care of itself. As your income goes up, then your savings and investment amount will also go up. So this is kind of just like a bonus tip. I think that will do it for today's video. Again, look out for in the future, I'm going to make this exact same video, but for someone who's a little bit more advanced in personal finance. This is great tips all for beginners or maybe people who only have one checking account right now and are kind of operating just out of one account. Then this is how you want to get started. For anyone who is a little bit more advanced and kind of has more accounts already set up, then the next video I make will be more for you. If you enjoyed this video, please give it a thumbs up and consider subscribing. And if you love hearing about personal finance tips, increasing your income, and side hustles, then you should definitely subscribe. And I will see you in the next one.